Do you agree that debt is equal to risk? Comment below yes or no so that we can understand what you actually think about debts. Welcome back to Extension channel. In this video, I will talk about debt to equity ratio of companies and share with you some of the companies on Nasdaq that have zero to little debt. If you enjoy this type of video, do subscribe to our channel and stay tuned. What is debt to equity ratio? This is a metric to evaluate a company's financial leverage or gearing. People often associate with debts with risk. Companies with higher debt means higher risk to the shareholders. Debt is actually one of the financing ways that companies use to finance its operation and growth. Companies borrow money from the public, we call it equity. While companies borrow money from financial institutions, we call it debts. If a company have to borrow money, of course, in the end, it has to repay the principal and the interest. Debt to equity ratio, in short, DE ratio, is calculated by dividing total liabilities by shareholders' equity. We can find these two items on the balance sheet in the company annual report. What is the ideal DE ratio? More often, we will modify the debt to include only long-term debts. We will exclude all the short-term debts, means any debts that need to repay within 1 year, we will exclude it. That is because short-term debts usually is cheaper. We will use a 50% benchmark to evaluate this DE ratio. But if you are a risk-averse type of investor, you can always set a lower DE ratio in filtering the stock that you want. How to do stock screening? You probably have a few ideas of metric in your mind on what type of companies that you want to invest in. But for today, we will focus on DE ratio. There are 3 ways to do stock screening. You can do it manually by checking the individual balance sheet of the companies, or take advantage of the free screener online, or by subscribing to certain stock websites. I will be using macro trend to screen the stock. Link is in the description below. Step 1. Select filter. Click on stock screener. Filter the exchange to Nasdaq. Set the maximum long-term debt to equity ratio to as low as possible. In this case, we only have 0.2, which is 20%. There are a lot of matching stocks. Since we are trying to filter good stocks, we will not focus on their price or dividend, but we can set the ROE, return on equity, to at least a positive 5% return. Step 2. Sort by debt ratio. There are a lot of companies with zero debt. If you are risk adverse, please only invest in the stock that you are familiar with and within your circle of competence. Popular stocks are usually with larger market capitalization. For example, we have Alphabet, which is Google, Facebook, and JD. Those are internet services industry. If you have been using Google and Facebook, their income are mainly from online advertisement, while JD is an e-commerce platform just like Amazon and Alibaba. Alphabet DE ratio is 0.08, meaning only 8% of total liability and equity is long-term debt. Facebook DE ratio is 0.09 and JD DE ratio is 0.20, which are relatively low risk. As I'm not familiar with the medical industry, so I will skip that first. Most people probably have started to use Zoom due to the lockdown recently. It is an internet software company that we use for video conferencing. Its DE ratio is only 0.07. For semiconductor industry, we have Micron Technology. DE ratio is 0.18. For beverage soft drink industry, we have Monster Beverage, which has zero debt. If you are into medical industry, you can have a look at Vertex Pharmaceutical, Intuitive Surgical, Align Technology. For computer software industry, you can check out for Intuit and Synopsys. The D/E ratio is a way to evaluate the company risk to its shareholders. Companies use debt for financing purposes. If a company borrows money to invest in its R&D, research and development, or buying more PPE to increase the production capacity, it is actually for long-term benefits. Companies with zero debts may be associated with limited growth potential. If you enjoyed this content, please give us a like. Thank you for watching.